My name is Mendoza. I'm a partner in the corporate department here at Akerman. My practice focuses on joint ventures, private equity funds, co-investments, private placements, kind of the whole side of the equity stack of transactions. And as mentioned, the topic today is going to be kind of the increase in co-investment structures, maybe the pros, cons, why we think that's happening. But first, I guess, Deborah, if you want to introduce yourself.
Deborah, I think you're tell her that.
Deborah, I think you're muted, Deborah.
Okay, there we go. Good afternoon. How is everyone? Okay, so Deborah Chan Mangan, Athena Investments. I've got 22 years of experience in commercial real estate industry, including being a developer of my own projects, 2017 and 2018. So my entity, the Athena Investments Group, is a capital advisory firm, and I work with an international family office that's in the business of providing private credit, debt, and equity financing. So technically, it's a multi-family office in 6 countries, and they pulled their funds together in 2012 after selling billions in assets. And since 2012, they've been lending off their own balance sheets. And on average, our loan size is about 125 million with a minimum of 15 million. So they lend off their own balance sheets, and sometimes they, depending on the project, they syndicate with 1 or 2 other co-investors. Thank you.
Peter, do you want to introduce yourself?
Yeah, my name is Peter Powers. I'm a 2nd generation member of MPI Family Office. It's my family's investment office. We are based in Tampa Bay, Florida. That's my video is not showing now. We're based out of Tampa Bay, Florida. The origins of my family's investment office is based in diabetic care facilities. My father and uncle started building diabetic care facilities about almost 30 years ago, and then started to get into our 2nd chapter, which is our family office, around 2008, with the onset of the Affordable Care Act and what happened in the private or the public markets, and we decided to transition into a 2nd chapter, which was building a real estate business as well as the investment business into operating companies. I took over the real estate platforms for my family about 3 years ago. Our focus has been in multifamily apartments, senior housing, and self-storage. We have around 6,000 apartments across the country, another 1,200 to 1,500 senior housing beds, and about another 1,000 self-storage units really scattered across the country. And then we also have a multifamily advisory side, which we call our Consortium of Wealth. We have families ranging from 25 million up to a few $1 billion that we advise with and invest alongside us in our private deals.
Okay, great. Thank you. Sam, do you want to?
Sure. On. Hi guys, mighty great seeing you, Deborah and Peter. Good seeing you guys again. My name is San Ing. I'm with a company called Skytian Capital. Tian is just Chinese for sky, so merging of cultures. We're a multi-office with capital from Asia and North America. When I turned 45 8 years ago, I took 5 years off and called it midlife crisis, but really traveled the world and did a lot of reading, wrote a book on investing and trying to figure out what to do with the capital. And when I turned 50, decided to move the majority of our funds into real estate, in particular multifamily. Started in passive deals as small as 1 million to 100 million with partners. And decided that this is pretty fun. And in the past few years, have also begun to GP deals and aggressively acquiring more and more assets in this asset class. I think Marty once us to talk about, because I've done direct deals as a sole GP, but also joint venture and syndication. So happy to share that as well.
And why that's become such a big trend. I mean, it's huge in Texas, but yeah.
Yeah, and I guess just Ahmad, and then we can start the panel.
Thank you. Hi, everyone. My name is Ahmad Ashrafi. I started A9 family office about 10 years ago and had a untraditional growth into real estate. It was always my focus. It was always my intention. And from going from not having any deals to having too many deals, I noticed that I was leaving too much money on the table. So decided to start Infinity, which is a platform for other family offices to join us into deals that we vet and that we curate. And Infinity has, in the past 18 months, done over 15 transactions and specialized in multifamily, industrial, and grocery anchored retail. We're doing pretty well, so a lot of consortium, I guess.
So as we were saying, I guess, you know, we were seeing this trend of increase in syndication and co-investment. And maybe Ahmad, you could start off by talking about kind of why you see the increase and kind of what you see as the benefits of this co-investment trend.
Well, it starts with family and friends always. They always ask you, what are you investing in? What are you doing? How are you doing it? And when you tell them about a deal that you're working on, it's always like, can I jump on this? And that's the simplest form of how we got into it. But the more elaborate answer is, you need to be very specialized in what you do. And I believe that not all family offices have the capability to understand every product, every asset class, every transaction, every market. And I think that being able to partner up with someone that knows more than you is actually very valuable, and you create a lot of synergies to family offices by becoming their right arm on real estate. So we've not only been able to curate deals, but also manage from A to Z. And that has caused other family offices to say, particularly international family offices, to say, if you're doing it so well for me, then just keep going. And I guess that specialty causes greater returns, less friction, and for us, it gives us that fresh equity source of going out to deals that are incredible and saying, if they're on the table, it takes a day to say yes or no. And when we have that fresh equity, we can really go, yes, we take it. And then that's how we get those higher returns.
San, do you want to add anything? I mean, San and Peter, I don't know if you guys want to talk, you both talk about a lot of multifamily deals that you guys are doing. I don't know if you're seeing a lot of this in that space as prices are getting higher, deals getting bigger, you know, before, or, you know, how interest rates maybe are factoring into the increase of co-investment, and maybe you have to raise more equity for the deals.
Sure. Peter, you want to go first?
Yeah. So, you know, we own a good bit of multifamily across the country. And in terms of the co-invest, so we do all of our deals through joint ventures with seasoned and experienced operators that have been through both market and debt cycles. So it's very important for us to find groups that really have strong management in specific geographic areas. So those partners, we look for them to put in 10 to at least 10% of the equity. Most cases 20% of the equity. So that's where they're co-investing, and then we'll come in and bring in the majority. So that's one way we go about it. And then there's another way where we do a co-GP type of structure where we'll put in, let's say, the majority of the GP equity and bring in an institutional limited partner. Kind of going off of what Ahmad said, we also have other families that invest alongside us. And the reason why they decide to invest alongside us is one, is our due diligence process. We have a pretty extensive due diligence process. I come from the private equity world, running acquisitions for private equity company. So I've really brought in that to my family. So that, with the experience as well as the transparency, where we can show them, we're putting in, let's say, $5 million into a deal, my family will put in the majority of that money. So having them see that we're putting in the majority of the money, putting skin into the game and showing them why we're, making that investment, we look at each property as a business, why we're buying that business, really, goes a long way getting them comfortable and having them invest alongside us. So that's kind of how we look about the co-investments. Lately it's been senior housing, which again, my family kind of comes from that background with our diabetic care facilities, which are catered towards seniors. So we have a unique perspective on it that has allowed us to find these opportunities.
Sure. So we're actually super excited for the next few years. The dust hasn't fully settled yet, but we're seeing some discounts, and we think that next year is probably a great year to pounce. So our goal is to acquire another 600, 800 million over the next 3 years in what we call a mid-market multi in not to get a little bit, mostly in the red states, states like Texas and Florida, and typically in the 20 to 100 million dollar asset range. And so what we've done over the last few years is we've built partnerships with the top GPs in each MSA to try to get access to the top 10 markets over the next few years, so that we can scale up and own these longer term assets.
Deborah, I don't know if you want to talk about some of kind of the investments you're looking to invest in and kind of your co-investment process, and kind of what, how many co-investors you look to invest with, and kind of what the process is for that, and maybe like the size of deals you're looking for this.
Right. So it really depends. Sometimes we fund the whole thing on our own. And typically when it's above 100, we start to look at other co-investors, 100 million in the first position debt. And, we would all be co-investors in a participation fund. And sometimes we do a 10% mezz to help with the capital stack. We focus now mostly on multifamily, including a lot of student housing actually, and senior housing was really been coming forward to us as for loan request is a lot of age restricted 55 plus active senior living. We like to invest in the Smile States, generally the top MSAs in the country. And we'll look at some secondaries. Tertiary is going to be tough unless there's some extraordinary situations there. And we have a huge, deep experience with hospitality, developing hospitality all over the world. And we still get a ton of requests. And in fact, one of the biggest names in hospitality asked us to help out with like 70 of their deals that can't get off the ground because of the interest rate and inflation credit environment. So it's a bit hairy right now. So what we've done with hospitality is we've curtailed on the leverage amount. So instead of going possibly up to 80%, we can now just go to 55, maybe 60% LTC or LTV if it's equity. So if I didn't make that clear, we fund construction projects and also bridge. All short-term, 2 to 5 years typically. And they're non-recourse loans, which our sponsors love. And because we're a small shop, we can move quite fast. We're nimble in our underwriting and flexible and incredibly innovative with our structuring. Just nothing like I've ever seen in my life. Just the best of the best. Thank you. Did I answer your question there?
Yeah. Are you looking to then get participants in these loans, or I mean, what's your process then of how much you keep yourself and how much maybe you try to?
Yeah, so it depends on so many variables. So if it would be, if for example, on 100 million, maybe it'd be like 30 or 30 or 30 I mean. So it really depends on the asset class, the amount of leverage the borrowers want, the credit risk. For example, we were looking to fund a hospital in Chicago, or a hospital campuses, plural. And we had very specific co-investors who really know deeply the hospitality asset So they were really great partners. Yeah, so to help I answer your question.
Ahmad, I don't know if you want to talk a little bit about the current kind of interest rate environment and how that's affecting whether you're seeking more co-investors or kind of when you're looking at deals, how is that affecting your current deal flow?
So I want to second what Sam said. I also believe that there's going to be a little bit of hurt in the market, and probably out of 50 deals, we're seeing maybe 45 are underwater, which means either they will have to refi with more equity, or they'll have to negotiate their terms with their lenders. Which means that for us, we need to have money on the sidelines to take them over quickly. So for us, that the market is going to become more dynamic. I think deals are going to become on the table on a shorter period, and I think Sam and others we're all looking at the same thing. And it's I like to say that investing is a competitive sport. If we are more agile than other companies, we can get the deals. And if we don't have the relationships, or if we're not as agile, somebody else will take them from us. And with how the market has changed into consortium-based investing, it also means that it's not only American money behind these deals. It means that there's the world's capital are behind really good deals. So you need to be even faster. I think that real estate is always a cycle. So people that have been through the cycle, either debt or equity or any, are cool as a cucumber. They don't feel that, okay, this is the end of the world. It's more the opportunity to go out and buy. So I think most people should gear up to be kind of hawkish on the market and be very agile to scoop up opportunities that I guess last year weren't there.
Yeah, just on interest rates. The way, I mean, interest rates obviously is concerned. We used to spend a lot of time hanging out with brokers. I'm sure you did as well. Now it's with the lenders, more time with them. And in the case of Florida, we're a lot more time now with insurance brokers. But interest rates is just one piece of a lot of factors that drive whether a deal works or not. So I think for us, we are still very actively looking as long as the numbers pencil out. We've loosened up on cash, but we're also finding good deals. I got my daughter involved in multifamily. She started studying at 17, and 2 months ago she found a small deal in St. Pete. We acquired it for 54.5% lower than the lender's appraisal. So there's opportunities that we're seeing already. So now that one doesn't have the same cash on cash we would find in a traditional, but there's just so much equity built in. So totally agree. There's a lot of ways to play the game.
Peter, I don't know if you want to talk a little bit. We're talking, as Ahmad said, I think correctly, we need to move, the idea is to move quickly and move on these deals and, be able to execute quickly. Obviously, sometimes setting up a co-investment group can take time, especially foreign money, getting them involved, having them do their diligence. How does that work for you, the process? Is it something that you try to get in beforehand? Is something that maybe sometimes you close and then look to syndicate afterwards? Is there a process for your co-investment?
Yeah. So that's a great question. So I'll give you an example of a deal we just closed 2 weeks ago, and another deal we're looking to close most likely before the end of the year. So the first thing to mention is finding these deals. It really is the relationships. A lot of people have money and sitting, being ready to invest, but unless you have the right deal and are able to, source that deal, it's not going to work out. So being creative there, having those relationships is number one. But in terms of a deal we just closed on a senior living facility, just got back from Boston. From the purchase price that they were looking to get, and we were under contract with in April of this year, to what we just closed on, it was a 33% discount. So we took over $10 million off of the purchase price because interest rates went up. This was a giant group, giant institution that had to sell the deal because their fund was closing for the end of the year. And with the interest rates going up, they wanted to find a buyer that they have history with, and can give them that surety of close. So again, coming down to the relationship, that's how we got the deal, and that's how we were able to carry out the deal to closing. And that deal is going to be, it's going to have a really nice cash on cash with a lot of upside on the deal. And then another deal that we're looking at right now, and again, these deals, we'll put up the money. We have a number of families that are quick to give it a yes or no, but when we give a commitment, my family will put the money in, and if we want to take some of that money off the table and syndicate it after, we're able to do that. So we always have that flexibility, which has been great. And then another deal we're looking at right now, which we're in the final stages of making a commitment towards with one of our operating partners, is a deal that we're actually going to be acquiring off of one of those auction websites. Really nice deal in a great area. From where the CMBS loan is on it and what we're under contract or what we won the auction at, it's a 75% discount. I believe it's almost a $23 million loan, and we're in the property for around $6 million. So that's going to be a really incredible basis, and we're looking to convert that to a better use. So again, having that wherewithal, being able to have the money to actually put it up and be able to close within a month and a half instead of the the 2-3 months that you typically have, is giving us the competitive advantage. We're able to act quickly. So that's how we go about deals. We'll put the money up. Our typical equity check is $2 to $10 million. My family will put up the money, and most of the time we'll keep the majority of the equity ourselves and maybe bring in a handful of other families that we have history with.
Yeah, Deborah, I don't know if you want to add anything about that, about your process and the timing, or if you have pre-existing relationships allow you to move quickly, or maybe there's a longer lead time for kind of your loans and investments, but if you want to talk about your process.
Muted, she's muted.
Yeah, you're muted, Deborah.
Yeah, given that the average age of my group is excluding myself, I'm sure I look younger than I look. I'm in my early 50s, but excluding me, the average age of the family office is 78. So you can imagine that their relationships run very deep, decades, sometimes 30, 40 years of knowing their co-investors. So yeah, so they have so much experience in co-investing with each other. This is even outside of the family office. They have partnerships. So that said, we are open to more other family offices to come in with us, a minimum of 250 million. So for example, we just recently started a fund for 600 million for just Mexico. We have several deals in Cabo and beyond. So that it's not really a formal fund. It's we just had them slated for Mexico. So yeah, we lend all over the world, mostly US, some in Mexico, Central America, a lot in South America, and Canada, and then beyond. So yeah, so it's really our own Rolodex. We just know which partners, co-investors would be interested in certain deals and deal size and geography. Yeah, so I'm real pleased to meet the other panel speakers here because we can possibly work on some deals together.
Ahmad, I know you spoke before about kind of investing on behalf of foreign, especially foreign family offices or other family offices. I don't know if you want to talk about kind of your process and trying to move quickly, given what you're talking about, the need to move fast on these things to execute.
So I believe that Infinity or the company we started is a bridge to a product. And there was incredible demand for that bridge. A lot of people wanted, like if you're in Europe or if you're in Asia or in South America, or in the Middle East, where a lot of our contacts come from, if you look to allocate money, the US real estate is probably the top of your mind. Yet the traditional way to get to real estate in the US is either through REIT, through fund, or through direct investing. And we're offering that fourth alternative that's a little bit more sophisticated, a little bit higher return, and a understanding of cultural difference. I think that to Deborah's point and to everyone's point, really, this is a relationship sport or a relationship industry where the more you know your people, whether it's deals flow or capital flow, the faster you're able to respond. So the reason we did we managed or created this way is because my wife lived there for 25 years, and I come from a different background, international background. It's one call saying, hey, I have this deal, multifamily, and we also do middle market and secondary and tertiary cities in, say, St. Louis, and they say, why St. Louis? And I say, because I love it. That's enough. Or if I'm putting skin in the game, like it's a faster way of doing deals. So I think it's the family office or the consortium space is going to outgrow the institutional one, because the institutionals are way too slow. They're dinosaurs in our world, and I think the faster you are, the better deals you'll be able to gather.
So I think Son and Peter both talked about how it seems like they're getting more into kind of the co-GP side of co-investing relationship. I wonder if you guys would talk a little bit about that, because I do know that at least from what I see, is kind of one of the last couple of years has been really a hot area. And just maybe talk about what you see as different in that role as kind of being the co-GP side. Maybe talk a little bit of whether when you're on the co-GP side, are you also trying to help get the LP cap on the deal, kind of like maybe that part of co-investing and going along with the sponsor side of the co-investing.
So 5 minutes left, Chris.
Yeah, so Skytian, we've been in this asset class primarily really for our own capital first. And again, as I mentioned earlier, as an LP, I spent the 5 years studying different assets and really writing a book about investing, and decided multi is the asset class I want to be in. We call it a holy grail asset that can survive different economic times. So in the past few years, we have done, as I mentioned, LP, JV, and syndications. And we also do ventures and other asset classes. I can say we've been getting venture capital returns in a much less risky asset class, even before the tax benefits kick in. And so the partners and LPs that sort of families that come in with us have asked us to put together a platform, including a lot of folks out in Asia. I'm not sure you guys have been following the last 2-3 days in China has been very, for lack of a better word, exciting, or scary. But there is a lot of money already out of China. It's tough to bring China money out now, but there's a lot of money out of China, and that compounded with the crypto situation, I think it's pushing a lot of demand. So long story short, we are putting together a larger platform, more blind committed capital fund to dramatically scale up this asset class in anticipation that sometime, perhaps the second half of next year, the dust does settle and we have hopefully a very good buy opportunity.
Peter, I don't know if you want to add anything, or we should just get questions if anybody had any questions.
I mean, just a few things. I'm just curious. Son, Ahmad, I mean, for someone to invest alongside you, I guess you could consider your consortium. What typical check size do they write? I'm just curious. And then, maybe we can join forces in terms of some of the investments. I'm not sure what your guys' thoughts are on senior housing or these hotel conversions that we're doing.
Well, Peter, I'm back in town for 2 days. Let's grab dinner. So I'm still fairly new to the game. I've really been 3 years as a GP in the space, but they're small as 100K to low seven figures in our deals. But we are now gravitating towards longer term, what we call legacy assets. So going forward, we will target, Peter, $20 million to $100 million assets in the B. I would say 15 to 20 year vintage, maybe 10 to 20 year vintage. So not brand new, not too old. There's loss of lease in markets like Tampa. There's also value add. And we intend to use this fund platform to hold onto these assets longer term. So let's get together and talk.
What type of equity? So it's 20 to, I'm just trying to understand, because there could be some synergies. I mean, 20 to $100 million, you guys are putting up how much equity? Just out of curiosity.
I mean, it used to be a size 80 and then now we're, as Deborah said, we're have to be aiming lower, right? 60, 65, potentially the asset supports it with some kind of pref as well.
And on our side, I always say yes to collaboration, so yes. And our minimum check size is $1 million, but we try to target people that have deeper pockets or have a possibility of investing more, because we've noticed that the person that does $1 million first does well, then they'll invest much more, and that's exponential growth. So answering your minimum ticket size.
Yeah.
And what was your second question?
Yeah, I mean, the first one was, what's a typical, family that co-invest with you? What do they invest? And then, maybe we could do some type of investing alongside each other. What was the second part?
Sure.
Any questions?
So my big question here is that, some family offices invest very big, on individual projects. Is it wise to try to invest more in groups to scale up faster? So I think there's two sides of the coin. One is you reduce risk by having a broader portfolio in theory, right? That's portfolio analysis, right? But the other one is that you can grow faster if you put, more smaller markers down on a bunch more stuff. Any thoughts on that? Is it closing thoughts?
I was saying, Deborah, did you have any thoughts on that?
You need to repeat the question.
Yeah, can you repeat the question, Marty?
Sure. He was asking whether you think, when you're looking at co-investments, does it make sense to try to guys, get more co-investors and kind of seed more deals or kind of scale up by larger investments and fewer deals?
So we're sort of on the defense side in terms of we get so many requests all around the country and beyond. So we're basically a service provider in that regard. And so when we have sponsors needing help to complete their capital stack, we kind of pick and choose. We can cherry pick very, very nicely which deals we want to invest in. So so I'll leave room for the other guys to answer that one as well.
I think having gunpowder is always good. So building those relationships right now, I think it was Ahmad that said, there's some opportunities coming up. And again, we have, a lot of money sitting, in our accounts ready to be invested, but it's always great to have other families that you have this relationships with. So you don't have to pass up on deals. And that's, that would not be, that's not what we want to do. We want to take advantage of the opportunities that typically come in phases, right? It's not just one deal. Maybe we get deals within a 6-month time frame that we want to act on. So I think it's important to have those relationships.
I would also second it's portfolio theory 101, diversify and lower the risk. But I think, as you can tell, real estate people are all deal junkies. They're always looking for the next big deal. And if someone can let you into a cool deal, then we'll always do it.
Okay, Ron Devori has a question. As long as the answer is 30 seconds or less, you can ask it.
We're getting into a lot of interesting sort of new asset class. There's vertical farming, combination of real estate and property. industrial parks for tech. Weird, places in the world, not necessarily just in the US. What do you, and a lot of them is more or less needs to be developed, needs to then turn into a project, and then, attract investment. How do we attract family offices to this type of what I consider, things that have a much potentially, less correlation with the real estate market, more correlated to tech market, real estate.
I'm gonna have to table that question for the next panel, because that's what the topic of the next panel is, things to do in 2023. This is more of a co-investment panel, so, but I think it's a great question. So, and also, all these people will be at dinner, and we can talk about that dinner time as well. But I'm gonna say what the question was. The question is alternative real estate, and how do you find more co-investors for these hybrid real estate companies that are business plus real estate, operating companies plus real estate. So I used to work in the casino business, of course, first job out of Wharton, and it was fascinating business. So that's the great example of what you're talking about. So